Good morning, traders and investors. My name is Roger Scott, and this is welcome to a midweek roundtable with Jeff Zennineri. Jeff, how are you today?
I'm doing well, getting ready for the big holiday.
It is. It's going to be great. I mean, I went to do some last minute shopping. Man, there's some lines out everywhere in the store. And, and by the way, before I forget, folks at home, if you guys want to reach out to Jeff during the holidays while you're eating your turkey, Jeff at joyofthetrade.com. My email is support@marketgeeks.com, and it'll get there very quickly. All right, let's get into this, Jeff. It's a midweek. It's a short week, fragmented week. We've had more data coming out from the Fed today than I think they've released in the last 4 weeks together. It's definitely an interesting time. What do you make of all of this?
Yeah, so volatility is kicking up. I mean, there are a lot of stocks that are beat down underneath the hood. I sent you a list this morning. We'll share it a little bit later. We'll look at it a little bit later, but there's a lot of stocks that are down 50% from their highs.
Yeah.
Big names too, massive companies, not some, dog and pony show stocks like Twitter, big companies like that. And, the Fed keeps pumping the liquidity. So the indexes are pressed higher, but underneath the hood, I'm seeing cracks. A handful oh, here we go.
Yeah, I just wanted to kind of share it while we're talking about it. And,
cool.
and I'm really glad that you brought this up. And I'm going to tell you why I'm glad you brought this up. There's a lesson here. A few weeks ago, Tom Busby, T-Bus, his office is like right across from the video room. So I come into his office a few days ago, and he shares the story with me. He has a couple of stocks up, and he's like, Roger, I'm looking at the volatility of everyday stocks. And, if you talk to a financial advisor, if you talk to a banker, if you read a book about investing, everybody will tell you that to keep your stop loss for conservative investors at about not, you'll hear different words, but it's anywhere from 8 to 10% on a stop loss. In other words, for position traders, if you take like investing 101, right? Well, do you know what the volatility for some of the average stock this year is? It's like 20%.
Yeah, I was going to say 20, 25.
Yeah.
I thought it might even be higher.
It may even and yes, it may even be higher. The point I'm making is that this year we are seeing gains, obviously, but the level of volatility we're seeing is just crazy. It's insane.
That's what I'm saying.
Yes.
So I think that's going to actually increase into the new year. I think that there's going to be a big take, because I believe very much, and that's what my monthly money flows is predicated on. I believe that these fund managers, when they have the opportunity to, and they have all the cash on the sidelines, like there's still a lot of cash on the sidelines. They will press the big winners into the year close. They will buy them up. They will keep bidding NVIDIA into the year end, these types of stocks, because they want to paint the tape on their own bonuses. They want to pad their bonuses. They want to make their performance look good. But I think once that phenomenon is over, come January, look out, boy, there's going to be fireworks next year. I think next year is going to be fireworks show. It's going to be an active trader's delight. But if you're a passive investor, you best be careful. And probably like what you always say, Roger, like focus on indexes. You can get that list that we showed proves to you that like if you're trying to be like the single stock investor and be cute with it, you can get your butt handed to you left and right, even in a really bullish market like this.
Yeah, it's and it's really frustrating for people, and I'll tell you why. And folks, if you're listening to this, pay attention to what I'm about to tell you, because I'm pretty sure this impacts you too. You read a lot of trading guides, you take trading signals, and you're used to a certain risk level, and then they're not working right now. So people are like, what the hell's going on here? Why do I have to put my stop loss twice as well? Things are different. The market is different right now. We're kind of like moving a lot, but not going anywhere, if you will. kind of moving, but not.
So if the money flows in and it doesn't buy single names per se, it's buying the index, right? So like it's buying equities. It just buys equities. It buys the SPY, and then it gets disseminated. But then from there, like the money flows into the big winners and out of the big losers. But there's this constant flow of capital that's coming into stocks because there's no other game in town. You can't buy bonds because bonds are sinking and they're already like nosebleed levels. So you're buying something that you get a 20% haircut. If you get a 200 basis point rise and you get normalization in yields, you're going to be out of the money in your bond portfolio, 25 to 35%. And you're never going to see that money again because we're probably never going to go back down to those low rates. for at least a decade
or
or something.
for at least another, right.
Yeah.
I was going to say another
So
20
smart
years.
money, people that we know, people that manage money like long term, like long money, they're not going to be out there buying, massive size and muni bonds and treasuries, et cetera, with the potential to get a real haircut. To hold, so you're going to have to wait till expiration, hold something for 20 years to get back whole. So money has to go into stocks still until the Fed stops their printing press and the inflation machine. Did you see Biden yesterday piss on him? Sorry, he peed into the wind. They released 50 million barrels, which is effectively 3 days worth of oil.
I was gonna say 2 days, but you got me beat 3 days. I mean, talk about and energy prices went up.
Yeah, of course they did. It was symbolic of how dumb they are and how the worst.
I'm so glad you're talking about this. I'm so glad you're talking about
energy policy in world history. Possibly, we were an energy independent country like a year and a half ago, and now we're begging the worst people in the world, the cartels, to
he's going to try to. He's going to encourage OPEC. They're laughing at him. They're saying Biden is going to impact. He's going to try to influence and encourage OPEC to make changes.
Disaster. If you want to talk about policy disaster, this has got to be in the top 5 worst U.S. policies I've seen.
It's so funny. It's so funny that you brought this up, because when I saw the headline yesterday, I was like, "Ooh, 50." So then I reached out to Matt. Matt's like, "Roger, it's like a 2-day supply." I'm like, "That's what I thought." I'm like, "What is this?"
The secretary didn't even know how much we consume in a day. She didn't have that number in front of her. It's like, you have one job. You don't know what the United States consumes in oil every day. That's what you do. I was kind of disgusted, but I'm thinking to myself, I'm sitting here and I'm watching this and I'm like, I'm looking at it and I see the oil start going. And I'm like, these guys have no idea how to stop this inflation train, boy. They think they can do the symbolic little 50 mil. You know what that strategic reserve is for? That strategic reserve is like if we go into Mad Max and we need to put gas into our fighter jets. Right. That's what that's for. It's not to make a political like, ooh, I'm dealing with inflation. Kind of bothers me.
Yeah, it made him look like you said, pissing in the wind.
Yeah, it came right back at him.
I'm so glad that you brought this up, Jeff, because I was going to bring up the exact same topic, and I was making fun of this whole scenario on yesterday's video and in my VIP room. I mean, it's crazy. Yeah. That's very funny. It is.
Inflation is the story. Is the story.
Definitely. So let me ask you this. So I know people at home are going to love this one. Powell. Let's talk a little bit about Powell. So notice as soon as he got reelected, the sentiment in the bond market turned south. He seems to be the most hawkish Fed right now in terms of rates.
He's not. It was him or this woman, Brainerd.
Yes, Brainerd. Right.
Woman Brainerd thinks that she can solve global warming through a magic money tree. She's like off the reservation in dovish. He's very dovish, but she's Looney Tunes.
She's just Looney Tunes, right?
So the market just went back to like, in my opinion, the bond market just went back to like, okay, so the knee-jerk in stocks was they went up because they were like, well, we know what he does, and he's a little bit hawkish because he's got to listen. Push comes to shove, they're going to have to stop this charade next year. They're forced to, and it's going to be political pressure because the strategic oil didn't work. This bill didn't work, and prices are going. They're not stopping. And so he's going to have pressure because it's going to be one or the other. They're going to say it's either fiscal policy that's creating inflation or it's monetary policy, right? Fiscal policy, the big spending bills that Congress and the White House is coming out with, they're not going to want to stop that. They're going to point the finger at the Fed and they're going to say, you guys are the bad. You guys got to stop this. The supply chain story, scapegoat isn't working. That's going to start to cool down, the supply chain thing a little bit. But he's going to be forced to raise rates and taper much faster than people think. I think that's the story of 2022.
Agreed. I agree. 100% agreed. Let's talk about a little bit about China. I know it's a limited session. I know you got to get out of here before the market opens. I wanted to ask you a few more questions and I'll let you out of here.
Good. Yeah.
What are you thinking about China, and how do you think it's going to play into with their?
Have you seen Baba? Like, look, the best company these guys have created in the last 50 years is breaking down completely.
Yes.
They cannot make money. They're handcuffed. So from an investment standpoint, I still think that they're going to have like these handcuffs on them. From a geopolitical standpoint, I think that, did you see what Jamie Dimon, the JP Morgan
Yeah.
CEO, he came out and he goes, I think JP Morgan is going to be around after the Chinese Communist Party is gone, which
Yeah.
is probably a correct statement. JP Morgan has like been around since for 200 years in the United States, 150 years in the United States.
Right.
It's not a crazy statement. They've been through multiple regime cycles, but the Chinese put tremendous pressure on them because JP Morgan still does a lot of, commercial banking in China. And so he had to walk back that statement because Xi Jinping got pissed off about it. But I think the Communist Chinese Party takes all these things and they put now you're on the naughty list, just like Santa, JP Morgan, and they're making their list and they're checking it twice and they're going to go after the people. They don't care. They're not beholden to shareholders. They're not beholden to the electorate.
No, you've made me realize this more and more. The more you and I talk, the more I realize you've made me understand how they think about money in a better way than I ever have, and that's really important because
radically different than us.
It's very unnatural for us Westerners to think that way. It's not it's not natural. So it's kind of like trying to put your head on in a, but you reinforce it consistently, and you're absolutely right. Based on their behavior, that's exactly what they're doing. They're putting their ego, if you will, or their ways
power.
Power. Yeah, before commerce, and that's dangerous for the second biggest country.
Well,
in the world.
We have it shifted in the West because we think that the power is consolidated in money, and that's where it derives from. But it's not. It's in totalitarian, authoritarian regimes. The power is might. It's military. It's oppression. Right. Here we think of things like, politicians have to have a good economy to get reelected. CEOs, executives of companies, they have to have their stock go higher and they have to blow out sales estimates to get their bonuses and to keep their jobs. So our entire way of thought and system is based on, get more money, keep your power. They have it in reverse. They're like, we keep the power and then we control the money. And so they don't care if the average Chinese GDP, per capita GDP is $5,000 a year or $2,000 a year. It makes no difference in the Communist Chinese Party. What matters to them is that, relatively speaking, they have civil peace, and they don't have any like revolution spurring up.
Right. Well, and I'm going to let you go in just a minute. I just wanted to tell you what I'm thinking the market's going to do. I think we're going to see more of a sell-off in tech and chip stocks. I think we're overdone. I don't think there's a major catalyst at this point to continue this madness that we've been seeing. Plus, earnings are behind us. I think we're going to see some shifting into blue chips and smaller cap stocks over the next couple of weeks. So I think we may see a little bit of a shift back into kind of where we were middle or end of summer, where tech sold off and dividend yielding stocks started moving higher.
So I think that's very good. Like, for me, your case is perfect. And I wrote an article about it on Monday for free. People could check it out at Joy of the Trade. I wrote where value, S&P value would catch up to S&P growth, because there was like a big spread between that. I think that rotation is going to happen, but I think that plays out like over the next 6 months. I don't think it's only like a 2-week thing. I think my case for the rest of the year is we have a little bit of a choppy week here. It's Thanksgiving. It's bizarre, but they start to ramp it again to pin it up into the month end. We get a CPI print that might be coming hot December 10th. Everybody, that's the big number that people should have on their radar. Circle that day on your calendar. December 10th, CPI was the hot number we had last time. It's the one everybody's paying attention to. Might get a knee-jerk sell-off on that. Bonds, yields go higher. And then a dip comes, and that's the dip to buy into the year close. They're going to ramp the stocks into the year close.
I couldn't agree with you. I think that's going to happen. The only thing I will add to that is I'd like to continue paying a very close attention to, as you said, consumer data and retail data. I think that's going to determine
retailers have been getting crushed. Some of them. And did you see Gap down 20%?
Yes.
Best Buy was down 15%. Yes, like individual names are getting hurt. Some of these.
Yes, and I'm very concerned because most of the time those end of year rallies are triggered by strong retail. So I'm seeing. Yeah, and I'm seeing consumer discretionary shift into consumer staples. So again, we may have that rally, but it may be more of a defensive rally than a. But yeah, I think it's
going to be liquidity driven. I think it's the last hurrah for all this cash to go somewhere into the year end, and these guys got to put this money to work before the year's over. They just have to. They have a mandate.
Agreed. Jeff, sorry that I kept you so long. I know the market's about to open.
I'm sorry that I had to rush us.
No, it's all good. Folks, if you want to reach out to Jeff, please do. Jeff@joyofthetrade.com. My email is support@marketgeeks.com. Please feel free to reach out to either of us. We won't bite. And Jeff, have a wonderful, wonderful Thanksgiving, and I will talk to you next week. And folks, if you want to see some of Jeff's services, they've been smoking hot. Go to wealthpress.com or go to joyofthetrade.com. Jeff, I'll talk to you later. Bye.
Thank you, buddy.
Take care. Bye.
Take it easy.
You too. Bye.